welcome to this web conference hosted by JP Morgan Asset Management. My name is Tai Hui. I'm the Chief Market Strategist for Asia Pacific here, and I'm delighted to be joined by my colleague, Stephanie Aliaga, who is our Global Market Strategist based in New York, but she happens to be in Hong Kong this week. And we've been having a lot of interesting discussions and client meetings about what's happening in the US. In particular, Stephanie's focus for the past few years has been on the development of artificial intelligence in the US. So I'm hoping to see this opportunity with her in town to really go through this topic, which obviously has been a focus for a lot of our investors, a lot of our clients across Asia Pacific, not just in 2026, but really going all the way back to 2024. Right after the ChatGPT moment happened. So Stephanie, welcome to Hong Kong, welcome to APAC. Great to have you here. So maybe just quickly recap in terms of market performance. If you look at the NASDAQ, frankly, why are we doing this? It doesn't look like it's doing very much. It's minus 0.6% year to date. S&P 500 up 1.4%. But at the same time, this small cap Russell 2000 is doing a lot better, 8% up year to date. A lot of the APAC markets are something that we've been highlighting at the end of last year in our 2026 outlook. Markets like Japan, Taiwan, South Korea, they're in really good shape. So TOPEX is up 13% year to date. Taiwan Stock Exchange Index up 14%, Kospi up 25.5%. So all in all, I think our key theme of broadening out into Asia, in particular to Northeast Asia, is working quite well. But if you look at, again, whether it's the 2026 so far or just going back to the fourth quarter of last year, we are starting to see a greater divergence amongst some of the hyperscalers in the US. And also in particular, some of the technology software industries that have been going through quite a bit of a correction. So for example, if you look at some of the software-related indices in the US, they're down 17, 18% year to date. So I think the market's asking some sensible questions. A, about the outlook for individual hyperscalers, where are they going to be, how that competition could change the landscape. And number two, or B, is who are the beneficiaries and who could be potentially vulnerable to this development. So these are the questions I'm going to ask Stephanie this morning, and hopefully we can get a lot of insights from her and her research on this topic really for the past 2 or 3 years. So to start, now if you look at the Q4 earnings results, a lot of these tech companies, hyperscalers, the giants, the Mac 7, their earnings actually were really quite good, right? Their revenue, their earnings, a lot of them beat expectations. But at the same time, investors are not focusing on that good news, but rather how much they're spending on CapEx. And a lot of these CapEx spends actually has been much bigger or much higher than what investors or analysts have been expecting. And as a result, some of these companies went through a bit of a correction since the start of the year. Do you think that concern is justified? And more importantly, what's the broader context of AI developments in the US right now?
Such an important question. Thank you, Tai, and thank you so much for having me. It's a pleasure to be here, escaping the frigid temperatures in New York City right now. Very convenient trip over here to Hong Kong. So talking about hyperscaler spending, this has been a focus for markets really throughout this AI theme, because it became clear quite quickly that to achieve our AI ambitions, to use these models, to make use of all of the powerful output that we can glean from AI, we're going to need more infrastructure. And that has led to 50 to 60% year-over-year increases in annual CapEx from these companies, the hyperscalers, predominantly in the US. This year, and just this past earnings season, we saw further ratchet higher in CapEx spending plans for 2026. So now that's at over about $650 billion just for this year, up another 60% since last year. So a lot of CapEx, and we're in this peculiar environment where these companies are still surprising on earnings, but the magnitude of surprise isn't really with earnings, it's with CapEx. And in some ways, I like to say that investors have really become tiger parents for these companies. We've gotten used to them blowing expectations out of the water, exceeding and, really blowing past estimates around revenues, margins, and so forth year after year. And now the hurdles to surprise markets are that much higher. And investors already have a lot of money on the table. Concentration to these names is very high, which is a key risk that we've identified for 2026. Now, is this the right way to approach what we're seeing right now around spending? Well, I think it's really important to have a really good grasp on why these companies are so confidently betting the house on AI. Why are they continuing to upgrade CapEx spending plans? The scale of investment here is part of the reason why investors were getting so queasy about the potential for an AI bubble towards the end of last year. Well, I think you don't need to look much further than these AI models themselves. In the last few months, we've seen a real acceleration in the capabilities of these tools to execute tasks autonomously. This concept of agentic AI, where AI can do things, not just write things for you and respond to your queries, but actually execute tasks from end to end and even more complex, economically useful tasks. We've reached a critical threshold with that, with the latest release of all of these different AI coding agents. And what that has shown is it's not a question of whether corporate America, whether companies broadly will adopt AI. It's a question of how fast. And what we hearing from these hyperscalers this quarter is the constraint to revenues is capacity. If they had more capacity, if they had more chips, they would be able to service all of this AI demand that is on this exponential curve, really. But the constraint is capacity. Even with all of the spending, they remain likely capacity constrained for the next at least 2 years. So that's the real impetus here. I think the question is around, ROI, competitive landscape, AI disruption. There's plenty of risk there for investors, but I will say you cannot say that these companies are falling asleep behind the wheel. They are pivoting aggressively.
So I think one point that you've been making for really the last 12 months, if not going further back, was the fact that a lot of these companies, as you rightly pointed out, the adoption rate is quick and high, both at the consumer level and also at the corporate level. We have a lot of data in the Guide to the Markets, both in the US and APAC, that shows you those adoption rates. The question now becomes is about capacity and how much, or rather, these hyperscalers, can they build data centers quick enough in order to satisfy this demand? And of course, there's a different question about power, right? We have seen strong demand for power, electricity in the US, which is a bit of a bottleneck for the time being, but whether there'll be innovative solution to that, let's see. But if I just come back to one of your earlier points about who benefits and who could be vulnerable. As I mentioned earlier, we've seen some of these software companies really getting punished when it comes to AI. What's your thought on that? Do you think the market is somewhat overdone with this type of pessimism that we no longer need software companies to help us? We can all do it ourselves now.
Yeah. Last week's moves were quite sharp, and they were pretty indiscriminate across the software basket. And we think that that was likely overblown. It's not that we're all of a sudden not going to need any kind of infrastructure. But the threat of disruption is absolutely real. And it is something that we're going to be continuing to digest for quarters and years to come. It's, some of our tech PMs have used this analogy. It's kind of like with cars. You can make the expectation that in the long run, every automobile is going to be an electric vehicle. But in the short term, does that mean that there is no value to be had in some of those more traditionally gas-powered vehicles? Maybe they could still be really great opportunities, particularly if there's been a massive re-rating in valuations for many years to come. And so there's going to be this kind of, when it comes to software, it is a differentiated industry. There are, I think, the software companies that just specialize on the application layer are seen to be as the most exposed to AI. Because in the era of vibe coding, which is essentially that anyone can now code software, you don't need to know a lick of coding. from my own experience, I've avoided all of the Python classes that they've tried to throw at me over the years. And now I've written myself thousands of lines of code. I've created some fun new websites, and I'm having a lot of fun with building out new workflows and creating my own agents. And what I found is I can now do so much more than I used to be able to do, because for things that I used to have to rely on someone else for, didn't have the tools accessible right in front of me, I can now do. And one way to just see the impact of this is if you look at the mobile apps on the App Store. Data from Sensor Tower shows that those apps, the number of new apps are up 60% year over year. Anyone can vibe code their own app now, just with a few hours and some training modules. And so if there is now all of a sudden a real collapse in the barriers to entry around applications, the business of reformatting data, putting it in a nice, clean, visual way to access it, that is a real threat to a lot of these companies. There's also the question of labor displacement. And many of these software business models charge per head. But that's a real challenge when it comes to AI because, well, on the one hand, per head can have a very different, a wide range of distribution when it comes to the intensity of usage. There are super users and there are the opposite of that. And so really when it comes to AI, these companies need to figure out how to charge per usage, but that's also challenging when you're talking about a new technology that you're trying to get people to use more of. And if you charge them per usage, you're also dissuading usage. So that's been a big question in the software industry is how do you charge for AI? And there's been a variety of different pricing models that have been discussed. But now I think the pressure is really on to defend margins. And software has enjoyed really wide margins for quite some time. And so I think the question is, how much of a risk is there around those margins? How do pricing models need to evolve? And how sizable are some of these moats of established enterprise software companies? Because they do have some real moats when it comes to the embeddedness that companies have with these systems. It's really hard to vibe code exactly what some of these established players have created. But now there is a new AI competitive threat that we have to keep in mind.
Talking about embedding, I'm trying to embed some of the questions from our listeners or our clients this morning throughout today's conversation. So keep the questions coming and I'll try to embed them where I can. Just to follow up on that point about vulnerability of both software companies and maybe some specific jobs at the moment, are there any other sectors or areas that could be vulnerable with AI development? And then the flip side of that is, are there any particular areas or sectors that could be resilient in this development?
I think the sectors that are most vulnerable also stand to benefit the most. And really, what AI is really good at right now are tasks that are repetitive, that are low risk, and really can be written in a manual. If you can write your job in a manual, you can train an AI agent to do that. You probably have a lot of data on how that task is done. You feed it to that agent, you can get pretty good precision. However, much of the tasks that make up workers' jobs are a lot more complex and nuanced. And I think one of the really key issues when it comes to AI models today, despite the fact that they have gotten exponentially better at completing complex tasks, reliability is still a big issue. You might be surprised to know that the current hallucination rates, the percent of the time that these models get something flat out wrong, ranges from 50% to 90% for all of the best state-of-the-art models out right now. That's Gemini, that's Claude, that's ChatGPT, DeepSeek, and so forth. So the challenge for that is there is a real need here when it comes to the orchestration of AI agents and the oversight. Now, if an AI agent gets something wrong with coding, with customer service, the risk of error is really low. And so instead, you're benefiting much more from the productivity potential of just being able to iterate faster and get content out a lot more. So the areas that have been most exposed, right? Coding, of course, software engineering, marketing to a degree. And then at the end of the day, the human can see the output and can refine accordingly. Getting to the opportunity, I think across professional services, anyone that has a desk job, I mean, how many of the tasks in your day could be automated or at least made much more efficient? And there's a really fascinating study that I was just reading this morning from Harvard Business Review. And they conducted like an 8-month-long study of this team working with AI. And they found that these employees were far busier using AI. They did far more stuff, going back to the sense of the amount of tasks that you can now tackle have been really widened. And people are much more energetic about working because, before AI, sitting down and getting started was like the hardest first step. Staring at a blank page, how do you get started? And now the tools that workers have to their disposal have been widened and democratized. So what does this mean going back to, thinking beyond software around the disruption that we could see around AI? This is going to be economy-wide. It's industry-wide. I think software, what we've seen here is the canary in the coal mine, but it's not going to be it's going to be a threat to companies, but it's also going to be a huge opportunity for companies and the workers in many of these industries that are going to be impacted.
I remember we've got a chart in the Guide to the Markets where we highlighted the adoption rates by different sectors. Not surprisingly, you have professional services, financials, software development, of course, telecommunication, education, always very high on that list. I think 60% of companies already using some form of AI. And at the bottom half of that page or that chart, you have manufacturing, construction, F&B, transportation, logistics. And it's not hard to understand why, because if you're an F&B company, sure, you may use AI to work with some of your inventory management, but you still need the people to help serve, to cook. Likewise with transportation, you need the drivers, the truckers to move things around the country. If you're in construction, well, you need the builders to help build. But I think one thing you've written recently, and we actually published this on our website as well, is the ability of robotics and maybe autonomous driving to change that in order to boost the AI usage of some of these more considerably manual work. Would you like to share a little bit more with us on that front?
Yeah, absolutely. So I think there's a few distinct phases of AI that we're going to see. First, generative AI. I think that was really kicked off with the launch of ChatGPT. Agentic AI, we may be seeing that kick off with Claude Code and these coding agents. And then third is physical AI. And the world of physical AI has been evolving and has seen a lot of advancement because of all of the advancements in generative AI and agentic AI. If you think about training robots, like physical AI, to actually do things that typically require human dexterity, back in the day, it used to be very difficult to train a robot to do something like fold a piece of laundry, crack an egg, open a doorknob. Because the thing is, the reason why those LLMs got so smart, we trained it on vast troves of data on the internet. But there is no vast database that says, how do you fold a piece of laundry? Or the pressure to apply to an egg, especially if you don't have the sense of touch, right? Now, all of a sudden, with generative AI, with the ability to learn through repetition and to learn with some form of agency, these models are now getting better at understanding general purpose notion, learning through action. And so the door has really been widened to the use cases here and just the scale of advancement. That's also behind the recent advancements in autonomous driving. Also the fact that you have generative AI, now these cars can read, learn through videos, through actual real-time video footage of what's going on around them and sensors that was impossible to do just a couple of years ago. But the challenge there is where it's quite easy for all of us to sit around the table, get on AI. We can have an hour workshop right now. And after that, we're going to be far more efficient after using these tools. With physical AI, we need to invest in all of that hardware. And there are other even bigger considerations when it comes to safety, security, regulation, and all that stuff. So I think the reality is when robotics becomes monetized and scalable, still into the future. But what's happening right now is laying the foundations. And we do think that there's a lot of opportunity in that infrastructure layer, in the software that's going to help power robotics, in the unique and custom chips that are going to go through all of that, and perhaps in some of the early players that may have early start advantage when it comes to this landscape.
I think it's interesting because robotics is not new, right? A lot of factories have been using robots for decades. But I think where you mentioned earlier, some of the finer movements, that sense of touch, equivalent of it, it means that, instead of just having a robot that is doing one task repetitively 24 hours a day or 23 hours a day, you can have the same robots now doing different tasks without being trained or programmed specifically.
Yeah.
So, sure, it's still going to be a huge capex from that perspective, but I think one thing to think about is which are some of the more advanced robotic companies around the world that is moving in the direction. If you take NVIDIA as an example, its success is not necessarily because it's been planning for AI for so long.
Yeah.
Its graphic chips is really good at graphic generation and et cetera, but it also just happens to be working really well on AI compute, and obviously they then develop this much further. So the question from my perspective is, are there any particular robotic companies or AI hardware sort of partnerships that could spring from existing companies that are already very good at what they do, but just with a bit of luck or a bit of tweak that can evolve into the next generation of robotics, deploying AI. So I think there's still a lot of opportunities that I think is still untapped, and it does require in-depth research and insights to pick out the right companies to be, a few steps ahead of the markets in order to explore those opportunities.
And I will add, I think the sectors that are really kind of first in line when it comes to harnessing the potential and the benefits of robotics are industrials, like manufacturing, will be a key focus, particularly in the US, and healthcare. So there we find many different stories of companies that are using, whether it's robotic surgery or whether it's, all of the robots that are in these warehouses in Silicon Valley these days being trained, that may benefit early on from the efficiency gains. Because particularly in the US, with all these efforts around manufacturing for AI and for even, reshoring and, efforts and so forth, we don't have the labor for that. So there's going to be a big focus on that. And I think we're eventually going to see that begin to accelerate in terms of broad adoption.
Right. I think we can have days of this conversation for the macro implications. I would argue that robotics may actually make demographics less relevant going forward, but that's a story for a different day. But taking advantage of you being in Hong Kong and APAC, a lot of our clients are always asking the questions, what are US investors thinking? What are they talking about? What are they worried about? How are they positioned, not just in AI, but more broadly in terms of asset allocation? What's your observation there?
Yeah. Well, look, no one sports a home country bias quite like US investors. And look, for a while, that's worked phenomenally for US investors. I think last year was a real eye-opener because you saw, yes, another strong year for US equities, up 18%. And yet, across the developed market leadership board or even global leadership board, the US is towards the bottom. And so in my conversations, I'm finally getting that openness to international diversification. I think clients are asking, okay, what kind of allocation makes the most sense? I think also there is still all of this bullishness around AI, but there is a clear desire to diversify from the concentrated mega caps, to invest in the beneficiaries of CapEx, invest in the broader AI build out, to even diversify some of your risk competitively around these US companies. So with that, I think Asia tech has been a huge standout there and really harnessing the build out and all of the CapEx dollars that are going towards chips 60% of all hyperscaler spending goes towards chips. And that chip ecosystem expands well beyond the design companies in Silicon Valley. So I think there's been a lot of openness in that. And then also questions of what are some of the underappreciated opportunities when it comes to AI disruption and innovation globally, and also some of the narratives that have just kind of missed with all of this laser focus on AI, right? International developed market banks have far outperformed U.S. growth since the market bottom in October 2022. So we have some great slides that show that. We have another chart that shows if you were to take one exceptional company out of the S&P 500, the most that we've seen perhaps in this generation. You take that one company out, you will have found that since the market bottom of October 2022, Europe and Japan have actually outperformed that new S&P 500. So some of those charts I think have really, helped make that conversation around diversification for U.S. investors. And I do think U.S. investors are very open right now to diversifying some of that concentrated exposure. Active tech strategies are also quite popular, but then looking beyond to alternatives, fixed income, international.
So I think just to comment on APAC technology, I think, again, this is something that we've been highlighting for much of last year, and we really re-emphasized at the end of 2025 and the start of 2026. As you rightly said, we can discuss and debate and predict which hyperscalers will have the best products or come on top in the US, but their data centers all require semiconductors and GPUs and memory chips, and a lot of that, if not most of them, do come from markets like South Korea and Taiwan. Again, we've got a great chart to show you that DRAM production, Korea, both in design and manufacturing, is incredibly dominant. Taiwan is effectively cornered the high precision, top of the range semiconductors in terms of fabrication. So I think, provided that you are still optimistic about the long-term development of artificial intelligence, I think Asia continues to provide a lot of interesting opportunities. And of course, there's the question of assembly, even some of the cooling components, the power supply components, all of that, a lot of it comes from this part of the world. So, I think there will be more volatilities in the US, especially with individual names. Again, we count on our portfolio managers to help us to navigate the outperformers versus the underperformers. But if you take a step back in terms of what facilitates this AI boom, to me, I think APAC plays a really critical role. And this is even before we start talking about AI development in China, which is obviously another key pillar of market support for the China markets. How the e-commerce giants are now really making use of AI in their products, in their services, which in the case of China is probably more difficult to monetize directly from models because a subscription model doesn't work as well in China. It works a lot better in the US, and that's why they need to integrate that into services in order to maximize the benefit. So I think, when we get asked the question of, is there an AI bubble? I personally, from my end or this part of the world, I think no, not yet. Because we are seeing great differentiation amongst different companies, and I think investors are making rational choices in differentiation. And also, I think Stephanie's right at the very beginning, we are still running short in capacity, right? We are not having a lot of idle capacity of data centers not being used. Definitely not. If anything, we need more. So even if individual companies in the US may not be doing as well as people expect, but the industry as a whole growing, that will benefit on Asia. The other thing I think is really interesting you mentioned is US investors now looking to diversify. We clearly hear this a lot in Europe, in Asia as well. I was talking to a international equity portfolio manager a few weeks ago, and this gentleman basically spent a number of years trying to advocate international equities in the US, and frankly, it was really difficult But last year was the first year that a lot of US investors start to recognize the benefits of international diversification, and his strategies have benefited from a lot of inflows into the fund. So I think it gives you some ideas of it's not just APAC investors, home buyers, and want to diversify, but actually a lot of US investors are also looking internationally for opportunities, and I suspect that would benefit markets like Europe, and in particular Asia. I gave you some numbers right at the very beginning in terms of the outperformance of Asian markets since the start of the year. And I do feel pretty optimistic that at least Asia will continue to do well. Whether it can outperform the US, let's see. But certainly the outlook continues to be really quite optimistic. That's all we have time for today. Thank you very much for joining us. Thank you, Stephanie, for being in town and spending time with our clients. Our next call should be in, I think, the third week of March with the next FOMC meeting. And of course, any urgent ad hoc events will obviously host calls as well. But meanwhile, if any additional questions, please feel free to reach out to your JP Morgan Asset Management client advisors. They'll pass your questions on to us or the appropriate investment team to hopefully answer your questions. Thank you very much. Have a good day.
Thank you.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.